Hey, this is Kevin. Hope everyone's doing well. I just wanted to comment on the market correction and just some thoughts that I had around being an investor. Financial planning is about everything, including investing, but investments in times of market panic are probably the most important part of the financial plan. So I want to augment my communication with this quick video. I just want to remind everyone of the facts. From 1995 to 2014, equities returned nearly 10% a year. And to give you some understanding of what that means is that if you had a dollar in equities, let's make it $100,000. If you had $100,000 in U.S. equities at the beginning, your money would double every 7.2 years. So after 7.2 years, you would have 200,000, and then the money would double again and again. Excuse me. Now, these numbers are meaningless in times like now where the emotional parts of our brain go crazy. And looking at some of the websites today, I got 15 alerts from CNBC today. 15 times they sent me a urgent alert. So there's definitely panic out there. And so the emotional part of our brain takes over in times like this. And I don't care how strong you are as an individual, you will feel a sense of fear. It's in our brain unless you don't have those areas of your brain that are able to activate. So I want to put some intellectual discussion here and I'll keep doing that if markets continue to be the way they are, because we need to overwhelm the emotional part with rational thinking. Bonds during this time did 6.2%. So about 11 years your money would double in bonds. Now here's really the take-home message with this. Although these did pretty well, stocks and bonds, the average investor only got 2.5% return. 2.5%. So it would take you 20-something years to double your money, the average investor in America. And I know we all think we're the better investor. We all think we're above average, but the average person in this country during this time period got a lot less than their investments. And I want to show you why. So this is the exact same time period, and this is the S&P 500. So why did equities do 9.9%, but the average investor during this time period, if you lived through this time period and invested, if we take 100 people, 50% got greater than a 2.5% return, 50% got less. That's what average means. Why did we get such poor returns when it went from $100,000 up to $700,000 over the last 20 years? Well, it has to do with emotion. And if emotion is really disturbing you, I'd ask you to think about, when do you need the money that's invested in equity markets? Do you need it today? If you need it today, then you're in the wrong asset. If, like myself, I'm 17 years away from retirement, at least when I desire to retire. Doesn't matter what's going on with my investment accounts today. I mean, maybe it does a little, but it really shouldn't. If I knew 20 years from now or 17 years from now my money would double 3 times over, I'd be okay with that. But the problem with investing is, in real time, we are these little specks. We are looking at the TV. We are getting texts, 11 texts today from CNBC telling me that things were terrible. And so what happens very consistently and every single cycle is that we as investors start buying more when markets go up, and we sell more when markets go down. This happens time and time again. And I'm also going to send a link to a video, an hour-long video on the history of crashes. And crashes have been going on since 1800. Those are when they at least recorded crashes in monetary markets. Crashes happen. They happen a lot. And so are equities more risky when you buy them here or down here? One thought leader that I follow says that equities always have the same risk. It's our perception of owning equities that is the problem. When things are going good, equities seem very, very It seems like a good time to own them. They don't seem risky. When markets start to correct, all of a sudden equities seem dangerous to own. But this is all part of the cyclical nature of markets. And so the second thing I would tell you is that to remind you that risk is different, volatility is different than losing your money. And the difference between volatility and losing your money is volatility means that you own a very broad base of hundreds, thousands of investments, and they are worth less and they are worth more. Not worthless, but worth less, and they are worth more. They are worth less, they are worth more. And so the value of them goes down. But if you own one stock, if you own even a dozen stocks, even 20 stocks, and 5 of those companies go bankrupt in a downturn, yes, you can be wiped out. That's not volatility. That's total loss. And so if you own a diversified portfolio, then it just goes up and down. It should not distress us as much as it does, but there's really nothing that I found that we can do about it except keep educating ourselves. So we've had this cycle now 3 times, and this was through 2014, and yes, it's come back down again. Now, this is the really surprising thing about markets. The more markets fall, as long as our country doesn't go bankrupt, and all the companies in the world don't go bankrupt, when companies fall, when stocks fall in price, their expected return goes up. So every time that markets go down and people start panicking and selling, if they would just hold on, they'd be fine. The expected return going forward is greater. And so if you are an accumulator like myself, I would just ask you to take a look at your accounts, hear all the news, but just remind yourself that you are an accumulator and you're continuing to buy, and that this is not as bad as it seems if you need the money 17 years from now. And if you're retired and you have half your money in equities and half your money in cash and bonds, well, then you're going to spend the half of your money that's not in equities. And by selling, we've already paid the price of markets going down. Now, markets can go down further, but eventually the companies are going to have enough earnings that their prices are going to be interesting. And so the more equities go down, the more we've already paid the price, and the harder it is to sell. But then when you get down to the final position where you just can't take it anymore, you panic and sell. And so let me show you quickly Leading Edge Financial Planning's systematic thoughts around investing. So it's all about allocation, asset allocation, which means what percentage of stuff do you put into different investments. It should be driven by goals, not in risk tolerance. Not, if you think investments are going up right now, if you think stocks are going up right now, your allocation should always be consistent. If goals in your life don't change, now if you lose your job and you're going to need to use your money that's in retirement accounts, that's different. If somebody dies and they're not insured and you need money, that's different. But if your goals are still the same, you really don't want to change your investments at a point when things are massively pessimistic. It's easy for me to say that, it's hard to do, but you want to have enough bonds that and cash that when markets go down, you don't feel so bad, and you want to have enough stocks and equities in portfolios that when markets go up, you feel good when markets go up, and you will make a good return. So diversification is critical. Don't own 5, 10, 20 stocks. Don't pick stocks. That's been shown to be a loser's game. Diversify as much as you can, and that way you're worried more about volatility than you are about just losing your money. And then control the controllables is the other one I want to mention. Low expense funds, avoid behavioral investment biases. That's what I'm talking about right now. And don't let the short-term information, the noise that's out there, the market, the machine of the news media is just doing everything they can to scare the living daylights out of us. If you have 10 years or more, chances of this correction being permanent is very little. So this is the famous Ibbotson's chart, and this only goes through 2012, but What we see here is we see 100% equities has a much bumpier ride, 75% has a less bumpy ride, 50% has a less bumpy ride. The differences in returns over this really long period of time, this is a logarithmic chart, it's huge. But the thing I want to mention is that this was a market crash. This was a market crash. There was another market crash in 08. Each one of these is a crash, and if you have a good period of time, the chances that you're going to lose 40, 50, 60% of your money is just not huge. Now there's always a chance, and I have to say that for legal reasons. So asset allocation, what you put your stuff in, what types of assets gets 91% of the expected return. Picking different stocks adds very little to your chances of getting better return, and market timing adds absolutely nothing. The problem with market timing is if we say if the market goes down another 10%, we're going to sell, then we basically wipe ourselves out from ever investing in equities again, because when do we get back in? What if equities go back up? Will we buy when equities go back up? The all clear never comes until the stock market is much higher and it feels again that investments are less risky. But there's just market timing has not shown to work. If it did, I would be advocating it. Stock selection, the same thing. So Charlie put this together, and he just showed that if you have a lot more bonds, which is in here, in the worst year since 1970, you would have been down 4.27%. If you had a more diversified portfolio, you still would have been down 34.68% in 2008, but you would have gotten returns of 9.82. So this is the time for us to be brave and keep buying, and it may get worse. It probably will get worse. Let me pause it and just show you a few more slides. So Charlie pulled this chart, and this will be the last chart that I'll talk about. Although this doesn't feel normal in 2016, it is normal for markets to go down and go up. This looks at from 1980 to 2014 that the average decline in a given year was 10%. That's the average decline. And we had many years, 80, 81, 82, 17, 18, and 17%, but the markets those 2 years finished up 2 out of 3 of those years. So the blue is what did the market actually finish at the end of the year. These red dots are how low did it ever get. So nearly every year we have markets going down, nearly every year. So how do we know in 1998 if this is a market correction or if this is a crash? We don't know. People predicted a market correction in 98. It didn't come until year 2000. So in 2008, we were down 49% at one time, finished down, I think it was 37%. But most of the years it's positive. Some of the years it is negative, and it's tough to live through those years. But again, that's what investing is all about. So I leave you with this. I'm not suggesting anyone should be happy with what goes on with markets. What I am suggesting, however, is that we enjoy our life and appreciate the joys in our life. And being an investor and having money and having the opportunity for our money to go up and down, there's a lot of positive things about that. I mean, what would Warren Buffett do today? Would he be panic-stricken, or would he understand that this is all part of investing? So enjoy your lives, and I'm here to help. Please contact me if you're concerned about your asset allocation and you don't know if it's appropriate for you. Let's talk. At Leading Edge Financial Planning, we have many tools now to show you what you own, and we very much want to talk with you about your situation. So if your goals haven't changed, don't sweat the small stuff. Anyway, thank you so much. I hope everyone is well, and thanks for watching.